Well, thank you very much, and good morning, everyone. It's great to be involved again with the CEDA EPO. We love a big audience as economists. We don't get the opportunity very often. Anyway, one of Paul Keating's advisors recounts in his memoirs back in the early 1990s how there was this point in the economic cycle where it was like a twig snapping, and that was the economy finally giving up. And this occurred just after the Reserve Bank had pushed its cash rate up over 17%, and it was just before the recession that we had to have that probably not too many people remember these days. But the shift from reasonably sort of positive views about the outlook for the Australian economy to pretty negative views has a lot of similarities with what we're seeing today. Certainly a few months ago, it all looked pretty good in terms of the outlook for 2019. So the question really is, has that economic twig snapped again? And is the gloom that we're seeing at the moment actually justified? Now, the recession that we had to have was, of course, the last time we had a recession in Australia. And if I'd spent the last 28 years on Mars and just flown back in this morning and kind of got an update on where the economy was standing at the end of last year, I'd be looking at a chart pretty much like this one. And what I would be seeing is that economic growth in Australia was running at about 2.75%. That's the number we regard as normal or trend growth for Australia. I would have seen an unemployment rate sitting at 5%, which is the level the experts think is full employment for Australia. I'd see an economy where wages growth is starting to kind of inch a little bit higher, but certainly not enough to shift the inflation dial at all. I'd see an economy where commodity prices are generating income once again, an economy where the budget deficit is disappearing at a rate of knots, and where the ratings agencies have decided that after all we are a pretty safe AAA bet. And of course an economy where policymakers still have some room to move should something be going wrong. I mean, all these things should actually be seen as good results. Nevertheless, the pessimism about how we're going to travel in 2019 has certainly lifted over the last couple of months. And what we've seen through that period, for example, the blue line on this chart, business confidence has dropped away pretty sharply. We've seen consumer confidence prove to be very volatile. It's up, it's down, it's all over the place. And this pessimism, I think, can really be sourced back to two key drivers, really. There are certainly plenty of downside risks to the global economic story right to now, and the problem really is to choose which one you want to focus on, because we can choose from trade wars, the mess that is Brexit, geopolitical uncertainties more broadly, volatile financial markets. The list goes on. But there are also some downside risks to the domestic economic story as well. They're largely centred on the consumer, and they're a reflection of that combination of very high levels of household debt, weak wages growth, and of course, more recently, falling house prices. Now, these risks are real. I'm not going to deny that. But there are other things happening in the economy that mean, I think, when we get to the end of this year and look back, we'll still see a pretty reasonable set of economic outcomes overall. Nevertheless, policymakers have responded to these risks. Their guidance on where interest rates are going here and overseas has changed quite a bit over the last few weeks, really. And what we're actually seeing at the moment is the return of the two-handed central banker, who's pretty happy to say at the moment that perhaps interest rates could go up, or maybe in fact they'll go down. And that probably covers a wide range of the possible outcomes when you're thinking about this year. So we've heard the Governor of the Reserve Bank, for example, say, on the one hand, if unemployment falls and if wages and inflation rates pick up, then probably the next move in interest rates is up. But on the other hand, if unemployment rises and it looks like we're not ever going to see a pick up in wages or inflation coming through, then it's quite reasonable to assume the next move in interest rates could be down. What to watch? Well, the governor's made it very clear. It's all about the labour market. Whether unemployment's going up or down, that's what's going to determine the direction of interest rates this year. So in a sense, it's all about where are the risks in the economic story over this year, and how are they likely to play out. Now, we start kind of from the global perspective before drilling back into Australia. Well, what we're really seeing at the moment, I think, is that kind of synchronised global upturn that's been underway over the last few years did come to an end as we moved through 2018. And we're now in an environment of desynchronised growth and certainly more uneven growth around the world. And you can see what people are focusing on, why they're concerned about this. So the chart on the left-hand side here, it's an economic surprise index. So it tells you whether the economic data has been either better than expected or worse. So anything below zero, worse than expected, that's where we're sitting right now. The middle panel shows you a measure of global policy uncertainty. So there are people who actually measure uncertainty, and what they're saying is that uncertainty is pretty much as high as it's ever been. Now, these two things may just mean that economists, firstly, have got their forecasts wrong, and secondly, it could mean that policymakers don't know what they're actually going to do next. Then, not surprisingly, the uncertainty about that is at elevated levels. The one kind of piece of hard data I'd highlight on that chart is, in fact, the last panel there. It shows you something from the Commonwealth Bank's Purchasing Managers Index. Now, this is a survey of the economy that gets done each month. It's kind of the first reading of what's happening in the economy when it comes out at the start of each month. And what I picked out here is the export order component of that measure. Now, it's up, it's down from month to month, but it's hard to see any kind of real negative impact, at least as yet, flowing back from weaker global growth in some countries into the Australian economic story. So we've actually proved pretty resilient to those negative influences, at least up until this point. Now, from an Australian point of view, when we're thinking about the global backdrop, it really is all about China. They are, of course, our number one trading partner. Most of those commodities that we sell go to China, so they're very important in driving demand, very important in influencing the price that we get for those commodities as well. And of course, the Chinese economy did slow during 2018, and that slowdown did add to that building perception of risks about the global economic story last year. But Chinese policymakers are on the job. They are starting to do things that we think that will ultimately put a floor under just how far China slows in 2019. So we have, for example, seen the Chinese central bank. They've shifted their policy stance from prudent and neutral to just prudent. Now, it doesn't sound like much of a shift, but by Chinese policy standards, that's actually a pretty significant shift in emphasis coming through there. And they've told us that fiscal policy will become more forceful and more effective. Nothing like a command economy to make things happening. But the point is, though, these changes are moving in a way that's supportive for the Australian connection into China, we think. So one example, the chart on the left-hand side here, the blue line there, it's a monetary policy indicator for China. As it goes up, they're adding stimulus. I track it pretty closely because it's been a very good leading indicator of the direction of commodity price momentum. And that purple line on that chart, that's the Commonwealth Bank's own commodity price index. So monetary policy is moving in a supportive way. And of course, when you talk about fiscal stimulus in China, a lot of it goes into infrastructure, and that's a pretty commodity-friendly type of spending as well. So while the economy may slow, that underlying kind of policy position in China is something we think will support Australian commodity prices and obviously good for the Australian economy more broadly. Well, if we turn back to the domestic side of the growth equation, I think one of the reasons that pessimism about the outlook for this year is overdone is that a fair amount of the growth story is actually locked in by the nature of the underlying drivers. And I've just picked out a few examples on this set of charts here. So, for example, the first panel, we're at the phase now where all those huge LNG plants that we've been building over the last 5 or 6 years are complete. They're being turned on. They're producing gas, and just a month or two ago, Australia became the largest exporter of LNG in the world on the back of that. And that's set to continue. And it's guaranteed growth because we've already sold all that gas. We've got to produce it and deliver it. We move on to the middle panel. Well, there's a huge boom in infrastructure spending underway in Australia right now. A lot of it's going into transport infrastructure, so it's going into multi-year projects that have started. And because they've started, then it will go through to completion, and that will drive growth for a number of years yet. And the final panel there, we're benefiting from still a very powerful combination of demographics and income momentum in the Asian region. So for the first time, per capita income in Asia is now above the global average. If you multiply that by the 3.5 billion people in Asia, then you've got a very powerful driving force there, and which you can see playing out in Australia's case through the booms in tourism and education that we've seen in recent years. So these sort of things put a fairly solid floor under growth for the year ahead. Another reason to not get too carried away with the pessimism is that some of the risks I talked about this time last year actually look to have receded. And just to highlight a couple of those, wages, stagnant wages growth. It's been a significant threat to the economy for a number of years now. But as you can see on that chart on the left, the sort of official measures of wages do look like they're starting to inch higher. Now, it's still very weak growth overall. I won't oversell it, but at least we do appear to be moving in the right direction. One of the things we worried about a year ago was the lack of investment by the non-mining part of the Australian economy. And the chart on the right shows, well, over the last 12 months, that's really come through in a rush, and all the forward-looking indicators there look pretty positive as well. So when we come to the housing market and the consumer, though, I think this is where most of the risks in the Australian economic story lie. Now, in a sense, there's nothing new here. Concerns about high levels of household debt and the housing market that lays behind that debt have been a feature of the debate since last century. And when you think about the number of stress tests we've had in the period since then, including a global financial crisis, well, those issues haven't been enough to derail the crisis overall. What is new, though, is that those issues became a concern for regulators a few years ago who worried about the financial stability risks that were building. So, of course, they took steps to put in place measures to reduce those financial stability risks. They were very successful, and in fact they've now taken off a lot of those restraints that were put on. But I think by fixing a financial stability risk, we have in fact created a new macroeconomic risk. And you can get some idea of the story, I think, from this chart here. So what the regulators worried about was too much investor activity in the housing market, too much interest-only lending going on, so they put in place measures designed to slow that. Very successful. This chart shows you the composition of housing credit, housing debt, whatever you want to call it, and you can see on the brown line there's been a big drop in the share of interest-only lending in the mix, big pullback in the share of lending going to investors as well. Now, it's how these things have been achieved, I think, which is generating the risk, and is a risk in particular in the consumer space. So what we've seen, for example, is a lot of people with interest-only loans have been encouraged to switch to principal and interest, and by doing that, you are reducing financial stability risks. But of course, a lot of these borrowers are discovering that their repayments are going up by 30 to 40% when they switch. Certainly, your wages growth is not going to compensate for that. And to the extent you pay your mortgage first, it just means that you've got less to spend elsewhere in the economy. So we've created an issue, a risk on the consumer spending front as a result. And we can see the impact of this on the Commonwealth Bank's own surveys. Now we run a survey of our customers. We have 2.5 million households in this survey each month, and gives us an idea of what's happening with their spending patterns, with their incomes, wealth, and the like. And this chart here just gives you a bit of a snapshot of what we're seeing in that survey at the moment. So it confirms that income growth, the purple line there, remains very weak. But it also shows, if you look at the green line, that right at the end of last year there was a significant slowdown in consumer spending coming through as some of these risk issues started to bite. And of course also makes the point, if you look at the red line there, that falling house prices are not good for household wealth, given the importance of housing in the overall mix. So these are the sorts of issues that the consumer is facing right now. Further falls in house prices could only intensify the story here. But I think a lot of that house price story, at least initially, was again an outcome of the regulations that were put in place with intentions focused elsewhere. And I've borrowed this particular chart from the Reserve Bank. Now what they've done is they've divided house price trends up into two bits, the pink line, which is what's happening with prices in areas that have been dominated by investor activity, and the blue line, which is just the rest of the market, so the owner-occupier side of things. And you can see most of the time those two lines sit on top of each other, as you'd expect, but a widening gap is there as those various regulations were put in place. It tells you the initial falls, as you can see, were really concentrated in those investor-driven suburbs, areas, as those regulations bit down on investor activity. Now, the good news in that, in a sense, is, well, if prices are falling because of regulation, then it's not a sign that there's some huge imbalance in the housing market that will produce these 30% type collapse scenarios that some commentators want to talk about. Nevertheless, once prices start falling, then it does generate its own momentum. So why buy today if it's going to be cheaper tomorrow? Negative gearing doesn't work when prices are falling and so on. And so you can see how a regulatory-driven impact is then got to spread more across the housing market overall. And certainly our view is that prices could fall further in 2019, but there are offsetting forces coming into play. What we're seeing, for example, is that first home buyers are returning to the market. It's one group, obviously, that does like lower prices, and they're responding to it. Bit of demand coming back in. And the demographics are very important here as well. This chart just kind of gives you a bit of a snapshot of different parts of the housing market, and making the obvious point that the biggest falls in house prices have been in Sydney and Melbourne. But of course, they were the two capital cities that had the biggest increases on the way up. But where the demographics are important is, well, in Melbourne we're adding 125,000 people a year to the population. In Sydney it's about 100,000. So it's a pretty solid level of injection of demand into the housing market that we think will ultimately help to stabilise prices. We're also seeing the supply side adjust. Construction activity is clearly past its peak as well, and these things will work eventually. As I say though, further falls to go, and you can see in the table there our views on the kind of peak to trough movements that we're going to see in key markets. I don't have the figures for Brisbane on there, but our forecast is a peak to trough movement in Brisbane of 2%. So clearly a much less worse outcome than we're seeing in the bigger state capitals. Now, while we think the low point for prices will probably be later this year, it has to be said that the leading indicators there are still looking pretty negative in terms of where prices are going. And again, I've just picked out a couple of examples here. So the chart on the left, the purpley coloured line there, shows you growth in housing lending. Well, it's falling at the moment, of course, but as long as housing lending is falling, then you can expect to see a negative picture for dwelling price momentum. No indication yet of a turnaround in that lending activity coming through. I looked long and hard to find something for the optimists in the audience, and that's the chart on the right, where the red line there shows you what's happening with the hit rate on the home loan part of the CBA website. Now, it probably tells you something about what economists like to do in their spare time, but the message here is, though, that hit rate has stabilised, and typically when you get a turning point in that hit rate, a few months later you tend to see dwelling price momentum move in the same way. So some very early, very tentative indications that fitting with that idea that the trough will be sometime this year. Now, the outlook for dwelling prices and for the consumer and for the economy will be a whole lot worse if in fact all these arguments about bank reluctance to lend, a credit crunch were in fact coming to pass. Because it doesn't matter about the demand side. If you can't get the finance, then you're not going to be participating in the housing market overall. And certainly that risk of a credit crunch is something that's being hotly debated right now. But I think once again you can trace a lot of the slowdown in credit to those regulatory-driven initiatives. So all the slowdown so far has been on the investor side, and that was the target. Provision of finance to the rest of the economy, to owner-occupiers, to the businesses and so on, hasn't really slowed at all. And I can show you just a few indications as well from the Commonwealth Bank's profit announcement last week that show you the same conclusion. So the chart on here, for example, the left-hand side panel, it shows you the approval rate. So what percentage of new loan applications are actually being approved? Well, it goes up and down from month to month, but it's really been a flat trend. So there's been no kind of pullback in that particular metric. Also highlight the panel on the right-hand side, the green bars there. Average loan sizes have actually gone up. Well, that doesn't sound like a bank that's become reluctant to lend. So I think the evidence doesn't really support the credit crunch thesis. Where the bigger risk really, though, is maybe from falling house prices. It does mean wealth is declining, as I showed in one of those earlier charts, and typically the response to lower wealth is to try and increase savings to offset that loss. And of course, the only way you can do that is by cutting consumer spending. So once again, it leads you back to the consumer risk part of the story here. And there are some indications of this happening. So this chart shows you trends in consumer-related lending for cars, holidays, the sorts of things that people borrow for, obviously. And you can see the dramatic slowdown that's occurred in the period since house prices have started falling. So there's certainly a real risk here, and one that we'll be watching pretty closely. What would help? Well, a further pickup in wages would clearly be a good thing, as would some increase in the tax cuts that are already sitting there in the legislation at the moment, and that looks like a quite likely outcome when we get to the budget later this year. Now, I've focused on the risks today because that's what the debate's all about, obviously, but hopefully I've given you enough of a taste of the positives to leave you feeling that the gloom is indeed overdone. And I'll finish at that point, and thank you very much for your time today.